Good afternoon, everyone. And thank you for joining us today on this webinar where we'll be examining the effects of COVID-19 and changes in older consumers' financial well-being. Okay. My name is Hector Ortiz. I am a senior policy analyst with the Consumer Financial Protection Bureau Office for Older Americans. And I am a lead researcher in the Bureau's financial well-being work. And my co-presenter today is Marie Rush. She is a research analyst in our Office of Research, and she is the author of our one of the authors of our April 2021 report that examined the changes in consumers' finances, including older consumers' finances. Most of you are familiar with our agency, and in fact, you probably got the invitation to this webinar through one of our lists. The CFPB is a federal agency that helps consumers finance markets work by making rules more effectively and consistently and fairly enforcing those rules by empowering consumers to take more control over their economic lives. You can learn more about our agency work at consumerfinance.gov. Our agency is committed to supporting consumers and providing consumers with up-to-date information and resources to protect and manage their finances during this difficult time. And as the situation of the pandemic evolves, we are in recent weeks have been focusing on the issues faced by homeowners and renters. You can find more information about our work in response to the coronavirus pandemic, consumerfinance.gov/coronavirus. And I want to disclaim before we begin our formal presentation that our presentations today are provided as representatives of the Bureau, but do not constitute any legal interpretation, guidance, or advice, and that the opinions that are offered by me and my colleague are our views and may not represent the Bureau's views. In today's presentation, we're going to cover what was the state of financial well-being of older adults in 2020. We're also going to look at the change in financial well-being for older adults between 2019 and 2020. And we are going to look at these questions through by examining some subsets of comparisons. We're going to start with a background of the CFPB financial well-being scale, and for those who are familiar with it, bear with us. It's I think important always to sort of go back and sort of explain the measure. We're also going to talk a little bit more about the survey itself, the Making Ends Meet survey, and some of the data and the limitations, so that you understand the kinds of conclusions we can draw from that data. And we're also going to compare older adults with younger adults. We're also going to look at specific subgroups of older adults. We're also going to compare financial well-being with other measures, particularly credit scores, and specifically credit scores and the difficulty paying bills. And we're going to have a specific focus on the percentage of older adults in the group of older adults that reported a decline in financial well-being between 2019 and 2020. So let's start with a little bit of background on the CFPB's financial well-being scale and the definition of well-being and how we measure it. The Bureau since 2012 has actually been working on this concept of financial well-being. We started this work with one-on-one interviews with consumers to learn what financial well-being meant to them. And we did this with a broad set of consumers from different geographies, ethnic, racial backgrounds. And the definition that you see here is sort of summarizes the views of consumers in all of this age groups and diverse population, and that it's a very holistic definition that has both concepts in the present as well as dimensions of the future, both from financial security and freedom of choice. And it is a state of well-being that reflects a person's ability to meet current and ongoing financial obligations, as well as the ability to be secure in the present and future against the financial shocks, but also to be able to make the choices that allow them to enjoy life. This was built using people's own words, and as you can see, there is an element of subjectivity in this definition. So there are elements of expectations, elements of preferences involved in how people measure and define their financial well-being. Even though it has that element of subjectivity, there is an entire field of psychometrics that has done a lot of good work at helping us develop validated, accurate, and reliable ways to measure a subjective concept. And the Bureau precisely pursued that. For this concept, we developed a scale to measure financial well-being and those subjective concepts. And that scale, we have made it publicly available, we have validated, and we have also tested the tool. The scale consists of 10 questions. Those are the questions that you see here. It has a variety of questions. One of them, that question number 5, I'm getting by financially. It's one question that it's used by the Federal Reserve specifically to measure annually in their survey of household economics, the well-being of Americans. But as you can see, the concept being very holistic, it has other questions here like giving a gift for a wedding or a birthday or other occasion will put a strain on people's finances at the end of the month. There's also a sense of control, like I'm concerned, my finances control my life, as well as I'm concerned that the money that I have will not last. The scale that we are employing for this particular study is an abbreviated version of it that has a 0.94 level of correlation with the 10-item scale. So you do lose a little bit of reliability and accuracy in the measure, but it is usually used by researchers in their surveys, including the Making Ends Meet survey, as well as the FINRA Financial Capability Survey has used this 5-item scale. Skip one. The scale is actually as good as the way we score it, and to make a reliable and a strong scoring method, we also rely on psychometrics to develop a strong scoring mechanism that pretty much relies on studying how difficult it is for a consumer or a respondent to provide a given answer to each one of those statements. It behaves like an SAT score in that it quantifies the level of the concept, but it's also through the difficulty of the item, but it also it is a normalized and standardized number. The scores primarily grouped around the score of 50 and the likelihood that you will find extreme cases, it's rare in a scale like this. We also, the scoring method has an adjustment for age, and it has an adjustment for mode of administration. And that's pretty much, we found that consistently the scale questions were answered differently if I asked the questions to someone versus if someone went and took the scale by himself, herself, and answered the questions in sort of a private setting and without, again, some of those social desirability biases. And similarly, we saw that with age, a continuous sort of change in how the questions were answered. All of those adjustments are done in the scores that you will be seeing in this presentation. The Bureau has done a lot of work in, you have a scale again from 0 to 100 in trying to bucket those into categories to kind of help us understand what's very low, what is very high. Through this benchmarking process, we have sort of put some ranges of score, and as you can see here, goes from 6 categories from very low to very high. We know that those buckets consistently are correlated with experiences, factual experiences, whether it is having less than $500 in savings, to someone reporting difficulty in covering expenses, being rejected for credit. And you can see some of those sort of drops in the probabilities as you move. No single experience sort of matches or has a full correlation with the score, and that makes sense. You know, financial well-being is a holistic concept. But the second thing is that here in this particular study that we conducted to do the benchmarking, one of the things that we learned is two individuals can have the same financial well-being score through two different means. And I just always give the example of a younger adult who is struggling right now financially, but has a very bright future in terms of career goals and the perspectives of increasing income and getting a raise. And then you could have an older adult who's managing well financially in the present, but is concerned about outliving their funds or having a long-term care expense. And so those two individuals can get the same score, but again, the dimensions of well-being that contribute to that score are different. So now I'm gonna sort of turn it to Marie, who's gonna describe the data and the findings. She's going to talk a little bit about the survey, but she's also, I know one of the questions that has come to the chat is what we define here as older adults, which for the purposes of our office are those individuals who are 62 and older, but the data allows us, again, to cut it as we decide, but for the purposes of this study, we did adults 62 and older. All right.
Thank you, Hector. Okay. So all of the analyses that we will be discussing here today are from our Making Ends Meet survey. So the Making Ends Meet survey is a nationally representative survey of adults with a credit record developed by the CFPB's Office of Research. The survey results provide a deeper understanding of how often consumers have difficulty making ends meet, how they cope with those shortfalls, and the subsequent effects of financial difficulty. The sample for the Making Ends Meet survey is drawn from the Bureau's Consumer Credit Panel, which is a 1 in 48 de-identified random sample of credit records maintained by one of the 3 nationwide credit reporting agencies. The Bureau first conducted the first wave of this Making Ends Meet survey in 2019. In May of 2019, we had about 2,990 respondents, and the second wave started in May of 2020. We did subsequently do a third round of surveying in February of 2021, though the findings in this presentation will be focused on waves 1 and 2. Okay, so for our analysis, we measure 3 key metrics over time. The first being the CFPB's financial well-being scale, which is the 5-question survey that Hector showed before. We look at reported difficulty in paying a bill or expense in the previous year, which is a question that we ask on both waves of the survey, which asks the respondent if they had difficulty paying a bill or expense in the previous year. These questions are intended to capture whether the consumer is in a financial situation requiring her to make choices in order to make ends meet. Lastly, we'll look at credit scores. Consumers' credit scores provide an objective measure of whether information reported to credit reporting agencies indicates that the consumer may not pay all debts as agreed. However, the credit scores do not reflect other important elements of the consumer's financial condition. And since we focused our analysis on changes in each of these 3 metrics over time, we limited our sample to those who had values for each of the 3 metrics, which means responded to both waves of our survey. And that left us with a final analysis sample of 1,742 respondents. So before we get into the main findings, I'd like to touch on some of the limitations and other considerations to keep in mind throughout this presentation. So first of all, I'd like to discuss causality. It's very important for us to note that we do not support any causal findings in this presentation, only associations. Another element here is the timing of the surveys. So we do show many different results for different groups, but when we conduct surveys, it's possible that if we were to conduct the same survey again with different respondents, we would get different results. And then for sample size, as we just noted before, the sample for these analysis was nearly 2,000 people. But once you start cutting into the smaller subgroups, the samples continue to get smaller. These smaller sample size do limit our ability to get reliable results or confidently assess whether the tendencies and patterns we're observing are significant. That is to say, they're not just by chance. So this brings me to the last point about statistical differences. We try to show you when a result is statistically significant by using an asterisk next to the point estimate. But just to note a couple of things, there are wide variations in financial well-being score generally. And as a result, you don't necessarily see the differences in the averages, but you can see interesting patterns when you look at the distribution. And lastly, the lack of differences in and of itself is an important result, especially when you are looking at categories where you expect to see a difference. If you are interested, more detail on any of these topics can be found in the April report that we will be linking to later in this presentation. Again, we're going to touch on some of the limitations of the Making Ends Meet survey, focusing on its representativeness. So it is important to note that since the Making Ends Meet survey is sampled from our consumer credit panel, it is inherently designed to be representative of adults with a credit record. So it will not include adults who do not have a credit record. However, as you can see here, in the comparison to the American Community Survey, the shares in each age group across the two surveys are fairly similar. The Making Ends Meet sample does tend to skew slightly older than the ACS, but that is likely partially explained by the higher rate of credit and visibility among younger consumers. All right, so now we are going to start looking into the financial situation of older adults in June of 2020. So we can begin by looking at the average distribution of financial well-being among both older adults and those in the overall population. On average, older adults have higher financial well-being than younger adults, about 5 points higher. This finding is consistent with other surveys using this scale. In general, a score of 57 is placed in the medium-high category, right on the line between medium-high and high. As Hector noted before, even in this category, respondents do still report some struggles. 1 in 5 in the medium-high category report that they do not have $500 in savings. These bar graphs show you how scores are distributed. In general, only 5% of older adults have scores in the very low or low categories, compared to about 11% among the overall population. And for any of you who may work on poverty issues, that percentage may seem low compared to poverty rates, but it is important to keep in mind that the financial well-being scale measures something different, and that very low scores are actual indicators of constant struggle and hardship, which is telling because it means that 1 in 20 adults, 1 in 20 older adults, so those 62 and older, despite having access to social safety nets of Social Security, Medicare, Medicaid, and other supports, are still experiencing ongoing hardships and struggles. All right. So here we're showing the average financial well-being score and the percent of who have low or very low scores among older adults by subgroups. On the right-hand side of this graphic, you'll see the green circles to the left of the black line indicate a below average financial well-being score, and circles to the right of the black line indicate above average scores. You can see that there are slight differences in financial well-being across gender, but the largest differences are across income levels. not only in terms of average scores, but also the share with low or very low scores. Those whose incomes are $40,000 or less per year have almost double the share with low or very low scores than those of average, than the average for older adults. These findings also align with prior research by the CFPB and others using a variety of samples. Okay, now we're going to turn to what we found regarding changes in financial well-being. So we just finished talking about the status of older Americans in June of 2020, and we're going to look at how that has changed from June of 2019 into June 2020. Okay, so first we found that overall, on average, financial well-being scores increased for all adults between June 2019 and June 2020. The overall change was 1 point for all adults 18 and up. But then we see when we segment by age that older adults reported an average decline in financial well-being between June 2019 and 2020, although that decline itself was not statistically significant. For adults, those 18 to 39, however, did experience a large and statistically significant increase in financial well-being between 2019 and 2020. You can see that this improvement was not shared by the older age groups. In fact, the older age group is the only one to experience a decline in financial well-being. And while we do not know for sure that the older age group didn't experience a larger decline or potentially no decline at all in financial well-being, we can say with certainty that they did not experience the same large increase that those 18 to 39 experienced. So this gives us an indication that the overall change in financial well-being is masking a larger increase among younger adults and either no change or a decline among older adults. As we've mentioned before, for metrics like the financial well-being score, it's useful to look at the distribution of the change. So here you see the same 6 buckets that we have come back to throughout the presentation. And you can see how they changed between 2019 and 2020. A very interesting pattern starts to play out when you look at the differences between the 2 years. The lowest buckets saw a decline, particularly in the very low category, which is a good thing. But we also see a decline in the very high category, as well as higher shares in the medium high and high categories. So overall, between 2019 and 2020, there appeared to be a higher concentration in these middle groups and decreases at both ends of the financial well-being spectrum. So here we are looking at the changes in financial well-being among various subgroups within the older adult population. So you can see that there are large differences between men and women, which is statistically significant. This finding was also true of the overall population, so not just the older adults. But as you look at the differences between other groups, such as race, education, and income, these findings, while directionally are what we would expect to see, the absence of significance indicates that there was a lot of variation within these groups, which is important to note. Alrighty, so now we're going to focus specifically on those who have experienced a decline in financial well-being. So here we compare the share who had a decline in financial well-being with those who had a decline in credit scores or newly experienced difficulty paying a bill or expense between June 2019 and June 2020. We find, again, that 45% of older adults had a decline in financial well-being, which is a larger share than those aged 40 to 61 and those under 40. But we also find that these declines in financial well-being were generally higher than the declines in credit scores across all age groups. We also looked at the percent of people who did not have problems paying bills or expenses in 2019, but did report difficulty paying bills or expenses in 2020. Among those 62 and older, 9% reported having difficulty in 2020 when they did not experience difficulty in 2019. Again, we noticed that the declines in financial well-being are more common than these other two metrics that we're looking at, which is not necessarily a surprise considering the financial well-being score is designed to be a holistic measure. So it captures some of the aspects of financial life that credit scores or difficulty paying bills or expenses wouldn't necessarily capture. All right, and now we will look at the decline in financial well-being by subgroup again. So we're looking at differences among gender, race, income, and education. And we're also showing the average decline in terms of points. So both the share within those subgroups that did experience a decline between 2019 and 2020, as well as the average point change in financial well-being scale or score. And as you can see, again, overall, 45% of older adults experienced a decline in financial well-being. There are some differences across subgroup, again, highlighting the differences between genders as well as groups. When we shift over to look at the average declines in terms of points, we can see that the average score declined by 9.4 points for all older adults, which is large considering that the overall average change in financial well-being was only 1 point for all survey respondents. And then when we're looking at the subgroups, the largest point decline was for those with a high school diploma or less, with their average financial well-being score declining by 11 points between 2019 and 2020. Okay, and finally, we look at the share of those who experienced specific pandemic-related events who also had a decline in financial well-being. The most notable metric here is that those who received forbearance on a non-student loan trade line, which will mostly be mortgage trade lines, were less likely to report a decline in financial well-being, with only about 30% of older adults who received assistance for financial well-being. This is about 15 percentage points less than the overall share with a decline in that age group. Additionally, you can see that unemployment was less relevant for older adults. Older adults who became unemployed between 2019 and 2020, only 43% had a decline in financial well-being, which is slightly less than the overall share. And those whose expenses went up during that same period were only slightly more likely to have a decline in financial well-being. So again, very important to point out and note the difference in the share who had a decline when they were receiving forbearance compared to overall averages, and others who experienced different forms of financial hardship during the pandemic.
As the data showed to us, while financial well-being scores increased slightly for all respondents, older adults' well-being scores appear to remain relatively stable between 19 and 2020, with a 0.1% decline, and that decline was stable, again, and not statistically significant. The changes in the distribution of scores between 2019 and 2020 suggest that this stability may have been the result of a decline in financial well-being among those in the highest levels of financial well-being, and an increase in the financial well-being among those in the lowest levels of financial well-being. There are some possible explanations for this unique pattern. We think that the improvements in those in the lowest levels of financial well-being and the declines among the highest level could be in the timing of the survey itself, and sort of the moment at which this survey was fielded in June of 2020. Most government aid had been provided, like forbearance was in place more generally. The stimulus payments have been distributed. Enhanced unemployment benefits were distributed. And some of the early uncertainty of the pandemic had been sort of was gone, and yet the stock market was still pretty low. And for the older population that is here, particularly those in the highest segment of the population, of the highest financial well-being levels, those are individuals who are more likely to have investments, to have IRAs and retirement accounts. So it is likely that that way in their sort of sense of financial well-being, their concerns about the future. It is also noticeable that people also in the highest levels of financial well-being tend to be business owners, tend to be also individuals with higher incomes too, that for which the unemployment benefits usually don't have the same level of replacement. So we think again that there is this combination of the aid that supports the sort of the lower end, and yet some of the uncertainty and sort of the challenges for those in the higher end of the distribution. Right. We also, in terms of subgroups, it's worth noting that older women, older adults of color, and older adults with incomes below 40,000, again, which are typically those with lower levels of financial well-being in a cross-sectional, like a one-year survey, were the ones who actually reported, were less likely to report a decline in financial well-being. In fact, those were the ones that had somewhat of an improvement. And again, this could be a possible indicator of the impact of the various forms of government assistance on those groups. And yet it is important to know that, despite the increase, as Marie said, the scores prior to the pandemic and even in June of 2020, the scores were lower. We're in a category that still showed a lot of struggle in this group, or a high probability of struggling with some basic financial experiences, and probability of of paying bills, having difficulty paying bills. Also, it is worth noting that the percent of older adults reporting a decline in financial well-being was somewhat similar to the general population, a little bit higher, like 4 points, but it wasn't that necessarily different. And it's important to know again that financial well-being was the category that had the largest percentage, and that again speaks to the holistic nature of the measure compared to, for instance, difficulty paying bills, which is like sort of a more fundamental hardship measure. And it's important to know again that this particularly the ability to pay bills, if you think about it, that's a more sort of measure that is appropriate to examine the role of the safety net and to what extent programs like SNAP, Medicaid sort of have the ability to protect individuals. And we did see that in that category was the only one where older adults, the percentage reporting a decline was actually similar for older adults as in as the other age groups. Apologize. And I think in terms of the factors associated with that decline, that was the last set of slides. I think it was really important to note that the data was as consistently as expected. Those who experience an increase in expenses and an unemployment situation were the ones with the higher probability of reporting a decline in financial well-being. But among older adults, it was particularly noticeable the role of forbearance. And for those of us who understand or have studied on the issue of debt, particularly given that the forbearance that is most likely being captured there is mortgage forbearance. It just shows that that was an important thing for older adults, even though, again, a majority of older adults probably own their homes free and clear, but for those who did still have a mortgage, it was an important factor to protect their financial well-being during this period. And I think, again, we just look at this, the relative smaller effect of unemployment, again, as a signal of the life stage of these individuals and somewhat the ability of some of them to be able to retire or claim Social Security early when faced with an unemployment sort of challenge or a other sort of labor market related challenges. As Marie said, we conducted a third round, so it will be interesting to understand the impacts of the pandemic over time. I will say that our data is really consistent with what the Federal Reserve showed. They showed that particularly they measure well-being with just one simple question, and they showed that April. That it was consistent with 2019, that the highest point, they measure April, July, and November, and that the highest point was July. So somewhat aligns again with our finding, and this is for, again, the entire population. But they did show that as they moved away from the June, July time period when the aid was distributed, the percentage started declining again. So we're looking forward to that February results, and we will certainly be informing the field about what we find there. I want to share, as we conclude this, more information about our work and where you can find more information about our financial well-being scale, as well as our Making Ends Meet survey. All of the information we share here, some of the information is unique to this webinar because it was particularly focused on older adults, but it's sort of an extension of the work that was published in April of 2021 from our Office of Research. So you can look at the report and you can learn more about the methodology of the survey, the questions, as well as the analysis for the entirety of the population. We also have, for those who are interested in the financial well-being scale, we have an entire section in our website, Financial Well-being Hub, that has our resources, how to use the scale, case studies. We have also all of the resources that you need, from an interactive tool to get your financial well-being score to paper versions that you can use with clients, as well as reports that we have published on a variety of populations. The toolkit specifically has benchmarks, complementary resources, and you can find this again in our Financial Well-being Hub. You can also go and get your own financial well-being score, and both in Spanish and English. We have the scale available digitally in an interactive tool. Again, all in the Financial Well-being Hub. These are 3 reports that have been recently published using the Making Ends Meet survey. The most recent one in May of 2021, and we invite you again to look in our research and reports section of our website to look at this, the variety of reports that we have, including ones on savings and financial well-being, as well as the use of alternative services, payday auto titles, and pawn loans. We appreciate again your participation today, and look forward to a sort of a newer version of this when that February 2021 data, we're able to sort of analyze it and put it to sort of create a trend in the financial well-being of older adults. Thank you again, and you'll have a great afternoon.